It's Halloween. It's spooky season. And this is a scary thought. I don't mind a little bit of gray hair, but going full-blown white, that feels very Dick Van Dyke-esque. I love Dick Van Dyke, but I don't know that I want to go full white hair just yet. A little bit of gray, fine. Okay, that's better. Much better. Okay. Let's talk about mega-cap tech. They spooked the markets in the last week. It's been simply a story, though, of expectations. Yes, expectations. It's a loaded word. Carries with it a certain level of responsibility. Think back to when you were in high school. If you were an A student, you were kind of expected to get A's into the future. If you were a C student, you probably weren't expected to get A's in the future. Both types of students face pressure, but only the A students have one place to go. Yes, the A students, they only have that one place to go, and it is down, down, down. The C students can go up or down. The same holds true for the markets and the so-called Magnificent Seven stocks that have powered most of the returns this year. They are the market's A students. We've heard from 5 of the 7 companies so far this earnings season: Microsoft, Google, Meta, Amazon, and Tesla. Apple reports in a couple of days, and Nvidia is next week. Now, Microsoft and Amazon, they delivered on their expectations. Google, Meta, and Tesla disappointed. Aside from Tesla, it's not that these companies missed analysts' expectations for sales and profits. No, what they missed were the heightened expectations of the market, delivering some ever so slight disappointments that either happened in their numbers or they delivered disappointments in some of the remarks about the numbers, their future expectations. The point here is that they just did not deliver the A-plus reports that Wall Streeters were expecting. They didn't deliver perfection, and so in the aggregate, they sold off. The tech-heavy NASDAQ 100 is still vastly outperforming the broader S&P 500 this year. So yes, expectations were understandably much higher for the Mag 7. So how should you view this as an investor? Because that's the real question. First, understand the expectations game. If a company is priced for perfection, meaning it has a high price relative to its earnings, maybe it's been driving heavily on momentum, then even a slight hiccup can cause it to fall. That doesn't mean it's a broken company. It just means that it got an A- this quarter as opposed to an A+. Just one quarter. Keep it in context. What happened this week is a great illustration for the entire market in 2023. The recession fears that caused such unease last year reversed as the economy continued to hold up this year. That led to aggressive buying that pushed the NASDAQ 100 to its best first half of the year ever. At one point, the index was up about 45%. The S&P 500 nearly rose 20% through the end of July. But then on July 31st, my wife and I had our daughter Margot. We love Margot. She's a wonderful little girl. However, the market on July 31st decided, yes, it is time to take a breather. Now, we can't put it all on Margot's shoulders because that same day, the Treasury Department announced it was going to be issuing a lot more bonds than the market expected in the third quarter. And so that caused interest rates to spike, and higher interest rates put pressure on stock prices. So it's not all on Margot's shoulders. And besides, Margot is rarely ever awake during the trading day to sell, even if she wanted to sell. Okay, full disclosure. Given the Fed's continued tightening, the rise in long-term interest rates, and the continued persistence of inflation, it seemed implausible those first half runs could continue unabated. So the market's giving back some of those earlier gains. Totally normal. And this past week seemed to be a convenient time to continue the selling given the slightly imperfect earnings reports. As a long-term investor, the best thing you can do is expect more of this volatility. Expect it even when things look good. A hot GDP number, low unemployment, the markets can flounder around. Just as the markets can rip a really hard rally in depths of despair. The markets are amazing at keeping investors off balance. So your best tools for navigating the ups and downs of investing are patience, a long viewpoint, long time horizon, and an automated investing plan that takes away some of your emotional decision making.